March 24th. I almost said February. March already. And it is flying by. We're in spring already, and we are ready for a really good market. I'm already hearing from agents that they're getting more people coming out on the market, more buyers are getting active, more sellers are ready to list. I think there's a little bit of optimism going on in the spring market this year, and that's good to see. So I want you guys to be ready for that. And for those that are not looking to sell, but they may not be in either their last forever home, HECM might be a good way to use that. And those that are in their home and they want to take some equity and leverage it for something else, another way you can use this. So I know Megan's going to give us all the cool details on that. So Megan from Encompass is here. She specializes in HECM mortgages. So she's going to share that with you all today, give you a little boost on your expertise in this area. And then she's always free to meet one-on-one with you and help you save some deals that may otherwise not go somewhere. So I'm going to let her jump on, and I think I've already given you, right, the driver's seat there, right? So Megan is going to go ahead and present for us today, and I'm super excited. Thank you for jumping on.
Hey everyone, great to meet you. Thanks for having me. I'm super excited to share with you guys today because I think there's a huge opportunity right now, specifically in this market for HECMs and how to utilize them to create more purchase business. So I know that I have about 30 minutes roughly to get through the presentation, and then we have some time for questions and answers. But if there's a question in the meantime that you need to bring up, just feel free to holler as we go through, because it's going to be a lot of information that I throw at you. And also feel free to reach out to me by cell or email anytime, and I'm happy to go through specific scenarios also as things are kind of popping up and you're thinking about maybe people you've talked to already in the past. So ways reverse mortgages can increase sales. One, you can help seniors by getting the house that they really want. You have a lot of seniors these days that either don't believe that they can sell and right size. Maybe it's because they don't have enough money to purchase for their area. They don't think they're going to qualify credit and income wise. So this gives them the opportunity to do that. Free up cash to improve retirement. We're seeing a lot of clients right now pull cash on their homes to purchase investment properties, or as the third option says, proceeds can be used as a gift for early inheritance. So people are grabbing cash from their home, or they're selling their home, getting cash, buying their new home with a reverse purchase, and using the rest to divide up into family members to do early inheritance, whether it's a down payment or buying an entire house cash in Texas. They can do this now because the reality is most children or heirs, if there's one or multiple, they aren't really wanting mom and dad's house. They want to sell it or fight over who's going to get what. So this can solve that now, and it's tax-free funds. If you are a real estate professional and not focused on the retirement market, you are missing out on assisting the largest demographic of people in our history that will need housing choices for many years to come. And that's the truth. Right now, we have over 11 trillion in home equity that's held by homeowners 62 and over. And a quarter of all home buyers are 60 and above. So that's going to more than double over the next 30 to 35 years. So what is a reverse mortgage? I can guarantee you that if you've heard of reverse mortgage, you have a negative idea in your head of what it is. Probably what it was is, you know, when I say the word reverse, I always tell my clients, I know you want to throw a shoe at my head because they know that their grandpa or their uncle got one of these and they lost their home and the bank took title. And that is true for what the program used to be, but it's not what it is now. So today, when referring to this loan product, I specifically refer to it as a HECM, which is a home equity conversion mortgage that is FHA insured for homeowners 62 and above. A reverse mortgage converts a percentage of their home equity into cash or line of credit. For the products that don't fit into the FHA high balance loan limit, Finance of America, also known as FAR, has a proprietary product for jumbo loans. So anything valued over 1.1 million, or for any condos that aren't FHA approved, can't do single unit approval, they can do the FAR Home Safe. And then lastly is the Equity Avail, which is a Finance of America, also their proprietary product. And this is for people that are maybe 55, still working, they are thinking about retirement. They can go into this loan product and still make payments over the next 10 years and then default into the reverse where no payments are required. So it kind of is setting them up in an early retirement situation. What's not on here is another loan product called the Home Safe Second. This would be for any clients that you have 55 and above who maybe don't want to move. Maybe they have a 3% interest rate on their first, but they want to pull cash out to buy a second property or pull cash to buy homes for their children. They can keep that first mortgage at the low rate that they're paying on and then pull a second out at a higher loan to value to do that. Realtor benefits. So produce more sales, increase your listings, expand inventory of higher value homes, you know, especially in the bigger cities where things are more expensive. If they are going to downsize, it's still going to cost more. So they don't have to use all of that cash from their sale. Work with builders, increase buyers' purchase power, market to various types of communities. The education on this, when you can share with a CPA or an accountant or trust attorney, they are loving this because it's keeping more invested and it's helping their clients get further through retirement. So it's also a great way to connect with new people who can refer business back and forth to each other. So what are the main differences? I'll start with a conventional mortgage. This is just a loan where you're going to make monthly payments, which will increase your equity. There is no age restriction. Monthly payments are required. You do also have to credit qualify and income qualify for this loan. Your equity will increase as your loan balance decreases. This will have a liquidity decrease. Borrower owns the home. They are responsible for paying taxes, insurance, and maintenance on the property. There is a risk of foreclosure if payments are not made. And contribution towards the purchase may include departure home equity proceeds, financed mortgage, or funds from retirement accounts. So the difference on a reverse is going to be an increase in liquidity. There is an age restriction. So 55 for the proprietary products and 62 for HECMs. There is no monthly payment that's required. That being said, it's a big misconception that clients can still make monthly payments. They could choose to pay principal and interest. They can choose to pay interest only. They can pay for 5 years and not pay at all. So it brings about flexibility and freedom for them to make the best choice for themselves. Their equity will decrease, loan balance increases, liquidity increases. Borrower still owns the home. So that's one of the changes from the old reverse to now, which is before a bank would take title. Now the borrower still stays on title the way they are if they want to be in a trust. They maintain property taxes and an insurance. It is a non-recourse loan. The contribution can come in the same way from the sale of their home or with reverse mortgage proceeds, and they're able to preserve retirement funds. So property eligibility. For the FHA HECM product, it has to meet the FHA standards, and it can be a single family home, 2 to 4 unit, FHA approved condos, and manufactured homes. But again, for anything that doesn't fit into this, we can do a proprietary home safe product to cover all of the rest of the properties. So let's look at a few strategies. Reverse for purchase downsizing. A 70-year-old couple in Arizona sell their home for $500,000 and purchase a new home for $350,000. They can pay cash for their new purchase, but want to retain as much funds from the sale of their departure home and increase liquidity. So here's what the strategy would look like. If they're to downsize without a reverse on the left-hand side, they would sell their home for $500,000 after 8% cost, around $40,000. Their net proceeds would be $460,000. Let's say they're downsizing, they want to buy a new home of $350,000. They would have $110,000 left after the purchase of that home. Now, if we look at them downsizing with the reverse for purchase, they're going to sell their home of $500,000, pay the same 8%, net $460,000. With the new home of $350,000 and utilizing a reverse for purchase, so a loan amount of $135,736, they would only have to contribute from their sale $214,264, which would leave them $245,736 left for retirement. So about an extra $135,000 different in this scenario. Let's say a couple would like to upsize. So a 70-year-old couple in Arizona selling their home for $500,000 and purchasing a new home for $650,000. They do not want any monthly mortgage payments. They're going to sell their home for $500,000, pay the 8% cost. Their net is going to be $460,000. With a new home price of $650,000, they would be required to pull $190,000 from their investments, retirement, to pay cash for that property. If they were to upsize with the reverse, after selling their home, netting $460,000, new home price $650,000, their new reverse loan amount would be about $259,000. This is what they would qualify for based off of their age and the value of the new home. And they would only need $390,000 roughly from the contribution of their home sale. So this is going to leave them with $67,000 left. So scenario one, they have to come in with $190,000. With the reverse for purchase, they would get to keep about $67,000 from the sale of their home. A 57-year-old single male in California wishes to purchase a new home without incurring a monthly mortgage payment. He's looking at a home around $1.8 million, which is, I know, a little bit closer to scenarios we have here in California. So he sells his home for $1.5 million. He has about $120,000 in cost to sell. Net proceeds $1,380,000. New home price $1.8 million. He would need about $420,000 to come in with at closing to buy that home. On a reverse for purchase, let's go to his new home price of $1.8 million. He would have a loan amount for $681,000 on the Home Safe product. So contribution from proceeds of departure home, $1.1 million, would leave him with funds left of $261,000. So that's a swing in the purchase with a conventional mortgage to a reverse of about $681,000. And then lastly, a reverse for purchase for a multifamily. A 62-year-old couple wishes to purchase a new multifamily home without incurring monthly mortgage payment. Their goal is to collect rental income from the other units in the property. Proceeds from the sale of their home, $500,000. Their new duplex cost would be $700,000. Funds required, $200,000. With a new mortgage of $200,000, their mortgage payment would be about $955 a month. With rental income of $1,500 a month, that would give them additional cash flow of about $505 a month. So say they did a reverse for purchase. The proceeds from their sale, $500,000, new duplex cost would be $700,000. The reverse for purchase proceeds would be a loan amount of $240,469. Their contribution would be $459,531 with no requirement for a monthly payment. So the additional cash flow would be $1,500 a month of income, and they would get to keep about $40,000 in the bank. So how are these loans repaid? It does not need to be repaid until borrowers pass away or leave the property. When leaving the property, this is a common question that comes up. If they have to go to a medical care facility for 6 months or rehab, this is still their primary residence. They plan to come back here, that is okay. So if it's a temporary stay elsewhere, that's fine. Leave the property means sell, or it's not their primary residence anymore. It can be repaid through the sale of the property or other assets, such as proceeds from a life insurance policy or loan refinance. No debt is passed along to their heirs with no personal liability. That's the FHA guarantee. And once the loan is repaid, any remaining equity belongs to the homeowner or their heirs. When we print out a proposal for clients to look to see what this program would look like for them, one of the pages is an amortization schedule, which will break down year after year all the way till they're 100, what it will look like if they don't make a monthly payment, what will the interest accrue to their loan balance, and eventually what is the equity that will be passed on to their heirs year after year. So that's helpful for them to look at to see in real life what those numbers look like. Once the loan is repaid, any remaining equity belongs to the homeowners or their heirs, and family members may obtain a short payoff for 95% of the current home value with a post-death transfer. Financial assessment requirement. So this is just the willingness and capacity of the borrower to timely meet their financial obligations. I know I mentioned that there is no real credit or income qualification in the traditional sense. So for credit, truly someone could have a 400 FICO and be in active foreclosure and they could still get this loan. They just want to put what's called a LISA, a life expectancy set aside on it, where the bank will pay taxes and insurance for the client. But other than that, it's not going to impact if they have bad credit, they can still get the product. For income, they just want to make sure there's a small residual income after they can pay their property taxes, insurance, a small residual income factor, and any credit debts. So for one person, they want residual income of about $500 a month. And for a couple, it's $900 a month. So typically Social Security income will cover the need for to cover all of their liabilities. If not, they can use the funds from the property to dissipate to cover that. So if there is a shortage, maybe they only make $900 a month in Social Security between the two of them, you can use cash to dissipate to cover the difference. Early gift of inheritance. So grandparents can get cash from their home with no monthly payment obligation and gift to a family member to help purchase their first home. If the grandparents have an existing mortgage, the reverse will pay that off and improve their monthly cash flow by eliminating their monthly mortgage payment requirement. Or they can get the home safe second and keep that first mortgage and just pull the cash from that second lien. So reverse for realtors, scenario one, if you are over 62 FHA or 55 for jumbo and have roughly 60% equity or more, you could eliminate your monthly mortgage payments. Scenario two, if you're over 62 or 55 and have roughly little or no existing mortgage, you could take out cash to buy a rental property or a second home. That is all. So any questions?
There are
Two in the chat. Okay, let me see.
one is about if they don't qualify for an FHA condo, the condo doesn't qualify with this.
Would this qualify?
Mhm.
Yeah, so if you have a condo that's not FHA approved, you could do a home safe on it, or you could do a single unit approval to do the FHA product.
And adult child take title for this type of loan.
If they are married, they both have to be on the loan. When they pass away, their heirs will have 1 year to make a determination on the property before they would either need to sell the property or refinance into a loan. If they are over 62, they can go on the loan though as a non-occupying co-borrower. So if you have a parent in their 80s and they have a child over 62 and they're going to inherit it, you can add them onto the loan, or a spouse or a partner, maybe they're not married. So then they could stay in the reverse after passing. If you're not 62 and you're not on the loan, though, you would have a year to either refinance and pay that off or sell the property.
Okay, so those are questions for me, and this comes from the other HECM conversation that we had, and that had to do with the rights of transfer, especially if they're going to inherit. So I'll just give you this scenario. Let's say I have parents that are in their 80s and I have a sibling who's near them, who may be in their 60s. So if they wanted to do a HECM, could they structure it in a way that they put my sibling on the title with the parents? And then would they qualify? Because they're over 67 or over 55 or whatever the number is. As long as they meet the age requirement, they can go on title and they won't have to like resell it or do anything with the heirs. Is that accurate?
Yep, they go on the loan as a non-occupying co-borrower or a non-borrowing spouse is how they're titled. So they're not on the loan, but they're allowed to stay in the loan.
Title, right? They're on title.
On title also.
Okay.
So
Cool.
they're actually written on the loan docs. We have to, compute them in a financial assessment and then yes, if it's till both borrowers pass away or all borrowers pass away. In that case.
Okay. Oh, yeah, okay.
Can you
I won't-
repeat what the responsibility is for the person that if they are signed on as a non-co-borrower or the other one, this other spouse one, what happens to them? I thought I heard you say they have to refinance in a year. Is that always the case?
No, so if they are, let's say it's a married couple and they're both on the loan, then they don't. It's when the last of the two passes away or decides to sell the property. So if there are 2 or 3 people on the loan, let's just say, and 2 pass away, the third one can stay in the home in this loan till they decide they want to sell the property or they pass away. They don't have to redo it.
Oh, okay. That's good to know. Okay. Very interesting.
All right, so the minimum age is 55 or 67.
So
Why is there a difference?
So 62 and above is going to be for the properties that are going into the HECM loan, which is the FHA one. Then Finance of America, they have a proprietary jumbo product, and that allows borrowers to be 55 or above. So it's 2 different loan programs.
Okay. Okay, so let's say for the average agent on the street, then how would we promote this to a farm or to our database? What would be like the question that might get some responses? What would we want to put out for that? Do you have something for us?
For buyers or sellers directly.
Probably for sellers, honestly, because I'm sure there's like the silver tsunami that we're talking about, right? With all these people with all this equity in the property, and they don't want to sell it, and maybe they've gotten, a COVID refi, and they're like, we're never selling because we can't afford it. So, what's the conversation for people in that situation?
This product allows you to right size. So if you want to downsize, if you want to move to a bigger property, it gives you the option. Most clients are afraid of moving because they don't think that they're going to be able to qualify for something else. They think that on their, fixed income with Social Security, and they don't really have credit anymore, they don't have the option to sell their property and get the house that they want. So it's just to know that, hey, even if the property values have gone up in California, you can still qualify to go be in whatever it is that you're most comfortable in the home that you need, because this product will help get you there. It bridges the gap. You don't have to have income. You don't have to have, great credit. You don't have to have a ton of cash, and then take out everything from your investment. So it allows them to be a little bit more comfortable in their retirement.
Okay.
We have a lot of clients that use this too, and this is going to get tricky, but to be able to move. So seniors quite often don't want to list their property for sale and find a new home that they're going to move into, right? And then do that move immediately. It's really why seniors don't want to sell. That's too stressful for them. So oftentimes we'll have clients get a reverse on this home, and they'll take the cash out to be able to go buy their next property. Then they can move into that, get a reverse on that one, and sell this one. And so it's kind of a 2 and 3 step process, but that's helping them be able to move in a way that's a little bit more palatable to them, because it's an easier on time frame, basically.
Right. Can you give some money move information on that one? Because you did say the 8% before, but what would they have to deal with to do the 2-step method?
Well, so on this product, there's not really loan costs other than the upfront counseling and an appraisal and your title and escrow. That's all you're paying for the fees of the loan. If you're selling your home, that's just going to be the typical, if they have a loan payoff and then whatever the agent's fees and title and escrow fees are. So there's nothing really additional other than your upfront closing costs. Now, if you do get the FHA loan, there is an upfront mortgage insurance premium that is paid, and that's 2% of the appraised value. So that can be a high cost that you would really want to utilize that one time. So we kind of structure it where maybe the first loan you get is a home safe because that's the jumbo product. It doesn't have the FHA insurance premium. And then when you get to your final destination, we do the HECM loan product.
So in
So
that's, are you there?
Go ahead.
Can you hear me?
Go ahead, David.
So in that scenario, you're doing 2 reverse mortgages, one for the house they're in and one for the new house. Why go that route instead of just a low cost home equity line of credit on the primary residence?
Yeah, they can do that. Typically they do the home safe second on that though. It'll allow them, it depends how much cash they need, but they can do that. There's ways to structure it where it depends. Does this house need to be fixed up for 6 to 9 months before they can sell it? It's, a picture we have to look at in totality, but it's making it more comfortable for seniors to wrap their idea around moving the home that they've been in for 40, 50 years when they know they have the time to do it. So this gives them the flexibility, either on the front end or the back end.
The follow-up question on that is, my thought, it just came to me, is maybe the reverse mortgage, the qualifications are a little bit easier than what a home equity line of credit maybe.
Yeah.
Is that true? Okay.
100%. Yeah. And good
Okay.
credit. Most seniors, they don't have credit. There are no scores, or they have one trade line. So credit and income qualifying for a HELOC, you could look at that first if you need a higher loan to value that you're going to draw out of to go purchase your next property. But then also now you're having to make payments on that. So if they're on a fixed income,
Right.
that is just added pressure where they could get a loan, take the money, and have no monthly payments.
Right.
Makes sense.
And it's on the property, it's not the person. So that's a big deal.
Yep.
Yeah.
Do you have anything for those 49-year-olds out there who might be looking?
I wish.
Hey, 55 is the new 30, they say.
Yeah, but I can't get that loan.
The reverse one you can probably try the reverse.
Oh yeah, that was my other question. So you said this for realtors. So what is the difference between person on the street versus realtors? Is there a difference on what the realtors can do or no? Maybe I misread the slide. You said something about here's the program for realtors and this is how this works, and maybe that wasn't like special for us, and maybe that's how
No.
it was like, what do I get?
You're not special.
Yeah, I
Yeah, I'm
think
not that special, unfortunately. Okay.
No, you're not.
the benefits in how to create more sales. So either
Okay.
more buyers or more listings by knowing this product, because it's a lack of education why most people don't know what it is. They don't know how to utilize it. They don't understand it. So to be able to have a better understanding, it's, when you're talking to people that maybe are like, we're not ready, or we don't think we can, it's just an opportunity.
Okay. So if we wanted to do a little bit more education on this, we can check in with you and Melissa, right?
Yeah, anytime.
Yeah. Okay, I think your contact information was in the chat. Who else has questions? Has anyone got a HECM or worked in this space at all? Because I'm like, I could leverage the heck out of this program. I don't know about you all.
Yeah, it's a great lead in because we do have a silver tsunami. It's like 10,000 people a day turning 55 or more.
Yeah.
I forget the figure. I know it's 10,000 or more.
It's a lot. Yeah,
Yeah.
every day.
Yeah. So, yeah, it's a great program, and I can't get in the chat on my phone right now. So is there any way to flash it on the screen and I'll just take a picture? Do you guys have a card or anything?
Yeah, here, let me try and share.
I think it was on her last slide, actually.
Yeah, let me share again, see if it pulls up.
Yeah.
Okay,
Screenshot.
open. Wow. Okay. Thank you very much.
Yeah.
Thanks
Um,
for having
That
me.
was very informative because I know a lot of people in this age group, including myself. And I think it's wonderful to hear that it gives options for people so that, you know, California is a death tax state, so they'll try everything to get in your pocket.
Yeah, I mean, the early inheritance, that is what we're seeing a lot of people use this for right now, is to pull cash out of their homes and divide it up between their children. You know, maybe they're buying homes cash in Texas or in other states. Maybe they're buying homes here for investment purposes, but to try and, you know, there's a lot of worry about taxes. So this is
Right.
a great non-tax way to use up your funds in a smart way.
Yeah. Do you do new homes? Like
Yeah.
under construction?
We have to have certificate of occupancy. So new construction, no, but
So,
we could
so
get a,
someone would have to get a construction loan and then roll it into reverse mortgage.
that's correct. Yeah.
Okay, well, that's a possibility too. Okay, that's cool. All right.
Any scenarios that you guys have, I need very few pieces of information, the name, their birthday, idea of a property address, and if they have a loan balance or what purchase price they're looking at. And with that alone, I can put together a proposal that
Mhm.
will do a breakdown of the numbers specifically. So what would they have to come in with to buy this property? And
Right,
also, what would the interest rate look like, an amortization schedule, so they can see what will it look like if we don't make payments over the next 30 years.
right.
It's super easy for me to pull that. So in any scenarios that you have and you want to look at the numbers, I can put them together and email it to you.
Okay, okay, sounds great. Thank you so much.
Very cool.
What's the max LTV on these
So
products?
it's based by three things: the value of the property, the age of
Mhm.
the youngest borrower, and then our current market. So you're kind of looking like if someone's in their 80s, between 80s and 90s, 45 to 50 loan to value. 70s is going to be around 40 to 45% loan to value. And then if they're in their 60s, 55 to 60, you're looking at about 35% to 40% loan to value. And as rates go down, those loan to values limits go up.
Right.
So is that the loan to value if they're getting cash, or is that the loan to value after the amortization?
Let's say let's say they're 65, their house is worth $1 million and they owe it free and clear. They would be able to take out a loan somewhere between 350,000 to 375,000.
Okay, and then it would increase every month. Yeah.
Yeah.
Okay, thank you.
You have a lot of clients too, if they're, you know, people are working later in life now. So it's people in their 60s often still have jobs, and we'll have them just make interest only payments. It's often less than what they're paying on their conforming mortgage if they have one. That way their loan balance won't increase. And then if something happens and they choose not to make a payment or they retire, they don't have to. They're already set up in the loan.
Interesting. Very, very nice. Thank you so much.
Hey, Megan, what is the most common scenario you're seeing right now? What are most people opting for as far as strategy on this? What are you seeing?
So strategy wise, I would say people that are wanting to buy a property, whether they have a 2-story, they want a 1-story, but the homes are more expensive in the areas they want to be in because they want to stay by their kids and their grandkids, and they don't think I am retired, I have no credit, I don't have a lot invested, this is the equity in this home is all I have, I don't see how I could buy a more expensive house.
Yeah.
So this is what's doing that for them.
Okay. Yeah, that's awesome. All right. Well, anyone else have questions for Miss Megan? I really appreciate taking the time. This is a product that I came across a few years ago. April introduced me to someone who does this, and I know she knows who that is. He had a very good presentation with scenarios and like, you know, here's how this person did and here's how it cleared and all the same kind of things. But unless it's in front of you all the time, you kind of forget about the finer details. I know it's out there, I just don't know how to implement it. So this is really helpful.
I think some of the programs that you just went over, I have not heard of before.
Yes.
So I think the reverse mortgage world has changed, and you know how it always happens when we get super tight market, then lenders come up with very creative ways to keep the market going. So how long have some of these programs been in, like the ones where you can be a co-owner, non-occupying co-owner? I have not heard of that before.
Yeah, so you could, if you're married, both borrowers have to be on the loan, and you have, if it's somebody's primary resident, they're going to inherit the property, they can go on as a non-occupying co-borrower. I mean, that's been around since I've been doing these. The Home Safe, the Home Safe Second, the Equity Avail, those kind of new proprietary products, they've been around at least for a decade, but they kind of get better year after year. The Home Safe Second is a newer one that we saw, I would say, in the last 2 years come in. That's been utilized a lot, especially since so many people have killer interest rates on their first and they don't want to touch it. This pull that second out, not have a monthly payment. It also allows them to have a higher loan to value limit too, as opposed to if this was their only loan. So it's kind of best of both worlds, but the products are always improving. You know, Finance of America, that's where I send all of my files. They're the largest servicer too. So any of the other reverse mortgage lenders that you hear of doing the products, they're being bought and serviced by Finance of America at the end of the day.
I'm sure. Yeah. Very exciting.
Yeah.
Open some new opportunities.
Okay, super. Does anyone else have questions? We have a few minutes, and then I wanted to kind of plug what we're going to be doing next week as well. Any final questions for Melissa or Megan?
I do have one more.
Okay.
Can you have multiple homes?
You can have multiple homes, but just one primary residence with the reverse.
Okay.
Yeah. But a lot of people will use the reverse to pull funds to buy a second home. That's very common.
So you can live in a home and you can have a rental.
Yeah, absolutely. Yeah, that's another thing that we are seeing is people are pulling proceeds on their home and buying other homes cash for investments to have that monthly cash flow coming in.
Right. Very nice.
Yeah, I think that's a kicker for a lot of people where they've got a really good rate on their primary and they don't want to refi for that reason. So we're all going to second mortgages because we're like, that's all there is. We don't know any better, right? So this is a really good program for that.
Sweet. If you have a second mortgage already, can you guys, if it's a low one, can you roll it into a new reverse one?
Yeah. Yep. We just pay it off and.
Okay. So that gives a little option for people that have already done some things and now they have more equity.
Yeah.
Okay, cool. Very nice.
You can, refinance, reverse mortgage, any of the products every 12 months. So if rates go down, property values go up, the principal limits are going to change. So it's always a good idea to look at, to see if you can pull out more cash for them, lower their rate.
Wow. That's great.
So you could say, okay, we're doing a HECM on our property, and then 5, 8, 10 years down the road, they could do it again with the value increasing.
Mm-hmm.
She said every year, 12 months.
Well, okay, so right, so I'm like,
that's the soonest you could redo it is every 12 months. Yeah. But there has to be a true value in doing the refinance. So it has to be we're lowering their rate or they're getting out, a significant amount of money on a reverse mortgage too. Say you get the loan now, you don't need the money. You can leave it in a line of credit. If it's an FHA, HECM reverse, that line of credit has a guaranteed growth rate today of about 7%. So every year that those funds are there, it's growing at a rate of 7%. And 5 years down the line, you now need the money. It's there available without having to redo the loan.
Wait, what about VA loans? If I might have missed it.
Well, if it would just pay off a VA loan, if there was a VA loan.
Mm-hmm.
I mean,
Okay.
if someone already has one,
Mm-hmm.
yeah, it would just pay it off.
Okay.
Whatever existing lien, the reverse mortgage could be the only lien on title.
Okay. Okay, because I have a family member. Or do you do all states, or is there any that you don't do?
Any states that ELG is licensed in, so I believe that's 48, right?
Oh, okay, so you're in,
47.
are you in
47.
Oregon?
They're working on New York.
Thank you,
Okay.
Brad.
Okay,
Yes, Oregon is one of them.
good. Okay. Great. Okay, interesting. Thank you.
Thank you.
Okay, awesome. Thank you again. So Megan's information's in the chat, Melissa's information's in the chat. I saved it to my sheet as well. So when we send out the recording, their contact information will be on it.
Wonderful.
Um,
Thanks.
Sorry?
I said thank you.
You're welcome. Okay, and then David McKeever, do you want to tell us what we're doing next week?
Of course, yes. Next week we're continuing our series on exactly what to say. You know, backed by popular demand. We're going to continue off that series. And in the book, exactly what to say, he talks about, you know, our clients, they do things for their own reasons and not ours. So I'm going to jump over and get into some of the questions we should be asking them in an appointment. And he calls those perspective changers. We're trying to change their perspective to kind of hopefully see things in our way a little bit. So it should help your appointments and conversion a little bit. And then also, I think next week is the last day of the first quarter, if I have that right. So I have a great exercise that I do at the end of each quarter, and I'm going to share that all with you guys, that exercises you should be doing as well, just to keep on your yearly goals. So 2 things next week.
Awesome, that's fantastic, and so much value on these meetings. So you know other agents who are not taking advantage of these meetings where they can get on, ask questions and get live help. These are really, really good content. So I appreciate everyone jumping on today. Remember to add your contact information in the chat. I did remember to save it this time, so we have that. And we'll be looking forward to David's magical words conversations that we've talked about before, and the perspective changers and all of that. So really good content. We'll see you next Monday. Make it a great week.
Bye, guys.
Bye,
Bye,
guys.
guys. Great seeing everybody.